Now, fixed assets turnover ratio. It's always equal to turnover upon fixed assets times. Turnover means net sales and fixed assets means net fixed assets. It is always expressed in times, not in ratio, not in percentage. Actually, this ratio tells about how efficiently fixed assets are being utilized in the company. Suppose a company made sales of rupees 1 lakh during this year. On average basis, their net fixed assets were rupees 20,000. It means their fixed asset turnover ratio is 5 times. If other factors remain same, you can generate 5 times sales of your fixed assets. At present, your fixed assets are 30,000. If you increase your assets 30,000 to 50,000, your sales will go 150 to 2,50,000 because your fixed assets turnover ratio is 5 times. It means your fixed assets can generate 5 times sales. So at present, your fixed assets are 50,000. You can generate sales of rupees 2,50,000. Be careful if other factors are the same. If there is no change in other factors. Now, we'll take up current assets turnover ratio. Means it establishes relationship between the current assets and turnover. Actually, it tells about how efficiently current assets are being utilized in the company. Means to what extent they are helping to generate sales. Again, I would like to explain the current assets. Current assets means any assets which is expected to be converted into cash within 1 year, like debtors, stock, bank balance, cash balance, BR, investments, etc., etc. And the formula of the current assets turnover ratio is net sales upon current assets times. If you are asked to calculate working capital turnover ratio, it means the formula will be turnover upon working capital. It establishes a relationship between working capital and turnover. Turnover means sales. Working capital means current assets minus current liabilities. So it tells you how efficiently working capital is being utilized in the business. Suppose in a company, current assets are 6 lakh rupees, current liabilities are 1 lakh rupees, credit sales 12 lakhs, cash sales 2 lakhs, sales returns 1 lakh. Calculate working capital turnover ratio. You know the formula is turnover upon working capital. Turnover means net sales upon working capital. Net sales means total sales minus sales returns. So total sales are 12 lakhs plus 2 lakhs, that is 14 lakhs, minus sales returns, that is 1 lakh, upon working capital. Working capital means current assets minus current liabilities. Current assets 6 lakhs minus 1 lakh. It means that will be equal to 13 lakhs upon 5 lakhs is equal to 2.6 times. It means the working capital turnover ratio of this company is 2.6 times. In other words, if this company has got working capital of 1 rupee, it can generate sales of 2 rupees 60 paisa with the help of working capital. If other factors are same, the company can increase the sales by increasing working capital. If other factors are same. Stock turnover ratio. Stock turnover ratio means turnover upon stock. It establishes a relationship between stock and sales. Stock means average stock lying with the company. How much average stock remains in the company and how much sales are generated in the company. And the formula is turnover upon average stock. Here the expression of turnover is cost of goods sold, not sales. So be careful if you are asked to calculate stock turnover ratio. The expression of turnover will be cost of goods sold. And you know the meaning of average stock. Average stock means opening stock plus closing stock upon 2. Actually, it tells how efficiently stock is being utilized in the company. Average stock means sometimes suppose you are running a bookshop and your friend is also running a bookshop. On average basis, you say that every time in your shop, the stock of the books is rupees 10,000, but your friend always keeps the stock of rupees 20,000. However, sales of the both organization is the same. It means you can generate the same sales as compared to your friend with low stock, but your friend has to generate the same sales by keeping higher stock. It means stock is being utilized more efficiently in your company. And you know the formula of cost of goods sold. Cost of goods sold is always equal to opening stock plus purchases plus direct expenses minus closing stock. Or another formula is sales minus gross profit. Or another formula is material consumed plus direct expenses. Material consumed means opening stock plus purchases minus closing stock. So you must be aware about all these formulas because you may have to use any one of them to solve the practical problems. Suppose in a company, during this year, the cost of goods sold was 12 lakh rupees and the average stock was 2 lakh rupees. It means the stock turnover ratio in this company is 6 times. Higher is better. Suppose there are 3 companies or 3 firms, A, B, C. And the cost of goods sold for all the companies rupees 1 lakh. And the average stock in A is 20,000, for B 10,000 and C for 5,000 rupees. Naturally, the stock turnover ratio for A is 5 times, means cost of goods sold upon average stock 1 lakh upon 20,000, that is 5 times. In the same way, for B, the stock turnover ratio is 10 times and for C, the stock turnover ratio is 20 times. Means C has got the highest stock turnover ratio and A has got the lowest turnover ratio. It means if A has got stock turnover ratio of 5 times, it means he purchases the stock for 5 times during the year, and then he keeps on selling the stock. The stock is finished, then he buys fresh stock and then starts selling. In this way, he turns the stock 5 times. You know, in 1 year, there are 365 days. And A and company turns the stock 5 times. It means 365 upon 5, 73 days. So, the meaning of 5 times, I mean to say stock turnover ratio for A and company means this company buys stock and keeps it with it for 73 days. Means it takes 73 days to sell the stock. And in the same way, B's stock turnover ratio is 10 times. It means this company takes 365 upon 10, 36 days. This company buys the stock and sells the same within 36 days. Then it buys the new stock. So in this way, you can have the idea what is the significance of stock turnover ratio. If the stock turnover ratio is very high, it means there are always chances of stock out. Means they keep very low level of stock. If the stock turnover ratio is low, it means the company's funds are tied up with the stock. Suppose in a company, opening stock is 10,000 rupees, closing stock is rupees 20,000, purchases during the year 60,000, wages 3,000 rupees. Calculate the stock turnover ratio. You know, stock turnover ratio is equal to turnover upon average stock times. Turnover means cost of goods sold upon average stock times. So, cost of goods sold is always equal to opening stock plus purchases minus closing stock and plus direct expenses. So, opening stock is 10,000 plus purchases 60,000 minus closing stock 20,000 plus 3,000 rupees. It means 53,000, and the average stock will be 10,000 plus 20,000 upon 2. It means 53,000 upon 15,000 means 3.53 times. The stock turnover ratio of this company is 3.53 times. If you want to calculate the stock turnover ratio in days, that will be 365 upon 3.53, almost or approximately 103 days. It means this company buys the goods, means stock, and sells the same stock within 103 days.